The Minority Market. Episode 12, Risk versus Volatility. What you must know. One of the most common mistakes beginners make in the stock market is confusing volatility with risk. When prices move sharply, fear rises. When prices move calmly, confidence increases. This emotional reaction leads many to believe that volatile assets are risky and stable-looking assets are safe. This misunderstanding quietly destroys portfolios and decision-making. To think like the minority, you must clearly separate what feels risky from what actually is risky. Volatility is movement. Risk is the possibility of permanent loss. These two are not the same, but they are often treated as if they are identical. Volatility is visible and emotional. Risk is invisible and structural. The majority reacts to what they see. The minority evaluates what can actually cause damage. Volatility refers to how much and how fast price fluctuates. It is a measure of short-term uncertainty. Prices go up, prices go down, sometimes sharply. This movement creates discomfort. Humans naturally associate discomfort with danger. In markets, this instinct is misleading. Volatility can exist without real risk, and real risk can exist without volatility. Risk, on the other hand, is the chance that you permanently lose capital or fail to meet your financial objective. A business going bankrupt is risk. Over-leveraging a position is risk. Investing in something you do not understand is risk. Emotional decision-making is risk. These risks can exist even when prices look calm and stable. Many beginners avoid volatile stocks because they feel scary, while comfortably holding slow-moving assets without understanding their fundamentals. This creates a false sense of safety. A stock that moves little can still be extremely risky if the business is weak, over-leveraged, or structurally broken. Low volatility does not mean low risk. Conversely, a strong business with temporary price swings may appear risky on the surface, but may carry less long-term risk if fundamentals are solid and capital is managed well. The minority learns to tolerate volatility when risk is controlled. The majority avoids volatility and walks directly into hidden risk. Another mistake is equating volatility with failure. When price moves against them, beginners feel they are wrong. This creates emotional pressure. They exit positions prematurely, not because the risk increased, but because discomfort increased. Over time, this behavior leads to buying high and selling low, the opposite of compounding. Volatility is the price you pay for opportunity. Markets do not offer returns without uncertainty. If an asset had no volatility, it would also offer no meaningful return. Trying to eliminate volatility completely usually results in eliminating opportunity as well. Risk increases when volatility meets poor behavior. Volatility alone does not cause loss. Reacting emotionally to volatility causes loss. Panic selling, revenge trading, over-adjusting positions. These behaviors turn normal price movement into real damage. The minority focuses on controlling behavior rather than controlling volatility. Position sizing plays a critical role in separating risk from volatility. A volatile asset held in an appropriate size can be safer than a stable-looking asset held too large. Beginners often ignore this. They feel safe and take oversized positions. When volatility appears unexpectedly, damage is severe. The minority adjusts size so that volatility is tolerable. Time horizon also changes the meaning of volatility. What looks volatile on a daily chart may look insignificant on a multi-year view. Short-term focus magnifies volatility emotionally. Long-term focus absorbs it. This is why the minority aligns position type with time horizon. Short-term noise does not threaten long-term conviction when risk is understood. Another dangerous misconception is believing diversification automatically reduces risk. Diversification reduces some risks, but not ignorance. Owning many assets you don't understand multiplies uncertainty. True risk reduction begins with understanding, not quantity. Volatility also creates opportunity for those prepared. When prices fluctuate, emotional participants make mistakes. They sell in fear and buy in excitement. The minority uses volatility as information. Sharp moves reveal sentiment, imbalance, and positioning. Instead of reacting, they observe. Risk increases dramatically when leverage is involved. Leverage magnifies volatility into permanent loss. Many beginners underestimate this. They believe leverage simply speeds up success. In reality, it speeds up mistakes. The minority treats leverage with respect or avoids it entirely until discipline is proven. Another hidden risk is overconfidence during low volatility periods. Calm markets create complacency. Rules are relaxed. Risk increases quietly. When volatility returns, unprepared participants panic. The minority expects volatility and prepares for it even during calm periods. A useful mental shift is this: volatility tests your emotions, risk tests your survival. Emotional discomfort is not danger. Permanent loss is danger. Learning to sit with discomfort without acting impulsively is a core market skill. One practical exercise is stress testing your decisions. Ask yourself, if this position moved sharply against me tomorrow, would my financial stability or emotional state be damaged? If the answer is yes, risk is too high, regardless of how stable it looks. Another exercise is separating outcome from process. A volatile outcome does not mean a bad decision. A calm outcome does not mean a good decision. Judge decisions by logic, risk control, and discipline, not by emotional comfort. The majority seeks smoothness. The minority seeks durability. Smooth returns look attractive, but durability survives reality. Markets are not smooth. Accepting this truth reduces frustration and improves decision-making. As you progress, you will realize that learning to live with volatility is unavoidable. Trying to escape it leads to poor choices. Learning to manage risk allows volatility to exist without harm. This episode builds on previous foundations. You understand what a stock represents. You understand money flow. Now you understand how to interpret movement correctly. Volatility is not the enemy. Unmanaged risk is. Becoming part of the minority means learning to stay calm when prices move, disciplined when emotions rise, and rational when uncertainty dominates. This is not easy, but it is necessary. The market does not reward comfort. It rewards preparation. When volatility appears, it exposes who prepared and who only hoped. Learn this distinction deeply. It will protect your capital, your confidence, and your long-term journey. Volatility will always exist. Risk does not have to.